What's up everybody, Tom here with another video. Well, it's that time of week again where we go over the stock market in terms of our technical analysis and news for the week. Today we'll be discussing the S&P 500, Nasdaq, Bitcoin, dollar index, gold, and everything else that's happening right now, including bonds. Everyone's concerned about these 10-year treasury notes, but I don't think that's necessarily the real reason the stock market is correcting or at least falling for now. Let's take a look together in what's going to be a very good video. Stay tuned. Alright guys, well where do we start? We always start in a heat map to understand what happened over the last couple of days in the trading market. Well, unlike Thursday, Wednesday, we saw on the markets a movement in all sectors starting to come down. So there was some recovery in some of the FANG stocks, some of the large technology stocks, where they weren't the ones attacked on the Friday close. But now banks, also energy and other defensive sectors are all being attacked in unison. We take a look at this chart here, which shows us the four major indices. You can see that all were kind of around, but now suddenly it was the Dow Jones and it was the SPX that were coming under fire on Friday. This means that the market is now broadening in terms of its decrease in price. We take a look for the month. Well, it turns out our stats were correct. The Nasdaq ended February. Now, if we took February, the start over here, and we look to the end of the month, you'll notice the Nasdaq is down 4.26% from pretty much the start of February in terms of period. SPX down 1.15%, and the other two indices, including the Russell, flat to up a little bit. We take a look at the sectors on Friday. What was getting beaten down? Energy, financials, utilities. The more defensive sectors were also being hurt, while at the same time the technology sector just stayed above as we pressured that downward support momentum at the 3800 at a few points, actually falling underneath but failing to close for the day, and we'll take a look at that soon. S&P 500, what happened in the major sectors over the last 5 days? You'll see the crushing coming into the technology and consumer discretionary market, with things starting to follow at the end of the week like we just discussed. The more defensive sectors, the financials and energy, starting to decline the last couple of days. So now that we've got a more broad market sell-off, what are the stats telling us about March and the rest of the year? Well guys, it's interesting here because I know all of us, we were thinking that February could be a declining month. We had a lot of euphoria in the market. That GameStop situation in AMC, we'll talk about that a little bit today, also made the market kind of become frothy, and it was actually a very, very strong looking month until just near the end. If we think about February, it's generally a declining month over actually 1928 to 2020 data. And March, while it's usually positive, we'll take a look at the last decade has been a negative kind of month sentiment. That being said, April has been one of the best months in all of history for trading. So if we scroll down through here and we think about the last couple of years since pretty much the GFC and what's happened, take a look at this. February, a negative month. March, notoriously a negative month. However, April, a great month. So is July. And May, even though we all talk about sell in May and go away, tends not to be that kind of way. So the thing is, what are we going to do? Well, March is going to be a very interesting, very tough time for investors. And I always say this on the streams, and you guys would have heard me talk about it before, you got to have the powder ready. And that means that if you have a little bit of money set aside, even Kathy Wood said the same thing, if you have some money set aside, you can always potentially invest it during these types of corrective pullbacks. If we close under key supports this week, there's something that's happening right now in the market I've never seen, and that is a double rejection from a key zone. We'll talk about that more soon. We're still in earnings weeks at this stage. Zoom putting earnings out after the close on Monday. That's going to be a very interesting one to see if they can hold it up. We've also got Fubo, which has been moving quite a lot recently. Splunk, Costco Wholesale, and others coming out with reports. So it's not as big as the reports have been, but we are still in earnings season and we are still seeing these results play out. Now, what's happening in the stock markets? Well, the volatility index for the S&P 500, as you can see over here, is at 28 on the close. That's spiking up. What could happen this week? We could potentially get to a 37.2. Now, what we like to do on this channel is go to the weekly and take a look at how the VIX actually closes, because the VIX is notorious for moving up and then quickly moving down and not being able to hold any price points. So holding a 28 is not bad. You'll notice that over here it was unable to hold even above really the 25 for those 2 weeks. For the first time in a long time, we've held here above the 28. The last time we saw this, of course, at the end of January, and it could mean that we spike more in volatility this week, potentially starting to angle towards the 37 and some real fear coming into the market. Now, if that fear is sustained, let's say it holds above a 28 to a 37 kind of area for a couple of weeks, it really will send the markets into a nosedive. The thing with volatility index is if it's sustained, then it will come and it'll continue to go through. It'll continue to push the market down. It doesn't have to continue to rise. It just needs to hold up there as much as possible. So let's talk about why all of this is supposedly happening. And this is it. Treasury yields, 10-year, 30-year bonds, all of those types of things. 146 in terms of price here on the interest rate. And you'll notice when you look at the monthly, we're on the monthly here, everyone's looking at this chart right now, and I'm sure a lot of people are talking about it, hitting resistance and closing right on it. 3 levels of support, 1 level of resistance on these Treasury 10-year yields, and it's closed right at the level where you're super unsure about what's going to happen next. And that's the problem sometimes, is it closes at a critical zone. All of these previous 2012, 2016, and 2018 lows have been met with resistance, and the market now has 2 choices. It sells off here, or probably it starts to consolidate at this level looking for the biggest move. The only way you're going to be able to tell what's going to go on Treasury yields is to dial in on the smaller time frames, such as things like the 4-hour, and see how price is interacting with this zone. So on this 4-hour, you'll notice it broke through, closed above, and now has come back and testing it from the top down. Now, if it can stall here and consolidate or even spike up, that's going to be potentially negative towards current sentiment in the markets. I don't tend to believe that these Treasury yields are as big a deal as everybody thinks about hypergrowth stocks and Nasdaq type stocks, because I've actually overlaid here the Nasdaq versus 10-year yields. And what you'll notice is the correlation is thin at best. If you think about this blue line here, which is the 10-year Treasury yields, it's sometimes risen, and at the same time it's risen, the Nasdaq has also performed incredibly well. So I don't buy into that as the excuse. I've said this several times on the channel, I'll say it again. When you invest for a long period, and I've been doing it for about 12 years, you'll notice same things occur. They come up with an excuse when the market goes euphoric or becomes overextended, and they use that excuse and blow it through the media. It doesn't necessarily make sense with what the reality is, and you need to cut out all of the noise and make your own decisions and empower yourself to understand the markets better. And that's what we try to understand here on the channel and here in the live stream. So if you're enjoying the content, make sure to subscribe and of course hit that like button. Let's talk about dollar index now. 91 incoming here on the dollar index. Previous resistance is becoming resistance again. If the dollar index is able to break through the 91, let's take a look at the daily here and just see how important this is. Firstly, the 20 exponential moving average, this red line here, it doesn't seem to matter anymore on the daily. It's just about this 91, and we close above that zone with a candle this week. What's going to happen? We're going to go towards 91.5. And as I've said many times, dollar index is all about risk on, risk off sentiment generally. If you can see dollar index rising and it's holding this level, it usually means risk is off the markets and people are pulling out of the markets, going into cash, going into other things like bonds, and just effectively saying, I don't believe the market is the good price right now. The real tellers for a longer term sustained correction are going to be that this dollar index on the weekly can get above its 20 moving average. This is the red line again here on the weekly. It's been dynamic resistance twice now, but notice even this weekly close, a rejection candle followed by a big bullish candle that is pretty much almost about to take out those wicks. 91, the key point for me this week on the dollar index, and we'll continue to do that throughout the live streams. What else is strange right now? Bitcoin. Bitcoin is continuously falling and continuously testing these supports. You'll notice here on the daily, if we go through this support here, this 45,000 zone and actually close below it, where's the next stop? I could see 40,000 for Bitcoin. Now, a lot of people aren't going to like hearing that, but the problem is it is declining. And when you take top to bottom and we consider the ruler kind of approach here, let's bring that through. If you went all the way to 40,000-ish or around there, you're actually returning about 30% of Bitcoin. And this is a standard pullback. 20 to 30% is not unheard of, even through bull cycles on Bitcoin in terms of declines. Taking a look at the 4-hour, you'll notice this. Support all the way through this 45,000. It has not closed below the 45,000 on any real significant time frame. A closure underneath 45,000, I think, will trigger flash sell-offs, and that could go as low as 40, if not 38,000, somewhere around that level. I would expect it to hopefully be picked up and then sentiment to return like it is returning in certain coins like ADA, Cardano, etc. Those ones are showing strength, and some of the market's still good, but some of the big ones like Bitcoin and Ethereum are certainly suffering right now. Let's now take a look at gold from the top-down approach. What's been going on with gold? Well, I've got a monthly up here just to put it in perspective of how far back this thing is crashing right now. Now, a lot of people are talking about the 1700 level being a key point. That's probably because the monthly 20 moving average is there, and you'll notice it's bounced twice around that zone. So it is a potential interesting level for you to look at on gold. It's kind of like catching a falling knife though. So whenever you're looking at these fallbacks, you've got to be very, very careful. I've also noticed some people drawing through something like this, which is a trend line, and then kind of lining that up with the 1700, talking about that 20 moving average. I tend to agree that this could be a critical zone, but for me, the way I look at these is I never buy that level. If you buy that level, what happens? The market continues to fall through and you end up losing more, or you end up putting yourself in a dangerous situation. What's better is to wait for some kind of structure on a time frame and wait for a breakout of that structure and get involved then. Wait for things like what we call the lightning bolt on the live stream and in our course. And this is where you get a trough, a peak, and a higher trough, and then you break through that level and then move towards the next zone. Try not to catch the falling knife, as even though you might get the best price, and then you can say to your friends, hey, I bought it at the lowest low. Most of the time, you're going to get the wrong price. And when you've traded for a long period of time, you will notice that, and you'll probably appreciate not taking necessarily those kind of losses that can occur. Silver, look at this steady decline here. It's only a 5-minute chart, but we take a look at the daily, and you'll notice something. Silver's trying to hold up. It closed in at a 26.57. I still think silver is the much stronger metal compared to gold, but everything here is coming down to some very, very important rejections. Look at silver. There is a trend line here. You go through these lows and you'll think, okay, silver's basically hit the zone that it should stop at and should hopefully find some kind of support and buying pressure. I'm a bit worried for silver just because I think it's getting pressured by external forces, but there's no doubt that the sentiment is good for silver, and overall the squeeze is more here than it is on gold. Gold is just not moving anymore, and all the money's going into Bitcoin. Let's call it crypto gold for now. Silver looks okay, may have some problems like all of the other metals right now. So let's talk about this stock market. What happened last week? Well, a lot. And a lot of things starting to make me think that it's lining up consistently with trapping us, the retail traders. Before, on our trend line, which has been very good at predicting pullbacks, every single time the market would pull back up here, it was met by buying demand. And if you actually think about this, what happened here? Well, we had that February GameStop situation. I actually thought this would be where the correction started. Then the GameStop situation happened and the market moved up. My thought process is that a lot of retail traders were coming in, and of course, a lot of retail traders were learning about, you and I were learning about options. When we learn about options, what happens? You get leverage. And when you get leverage, Wall Street like to take that as an opportunity to, of course, teach everyone a lesson. Each one of these buy wicks was met by, I believe, a lot of dip buying processes from retail community. I had people messaging me, they said, I bought the dip. And the dip was literally about $2 on that particular stock. So I think if that's the type of thing that's happening, this shows all that trap. Then we got the flash crash that we did live, and this was where they hit the hypergrowth stocks, those stocks that were in ARK, Cathie Wood's fund, and everything else has been doing well. Then the market declined again, and it really exposed the fact that I believe this is happening, because what did we have at the same point in time? Options expiry. Then On the Friday, we had another instant recovery in the markets, met by selling into the end of the day. So is Wall Street actually playing with retail investors? I would say so. And if this continues and this trend continues, let's have a look at the daily here again. Where are we? Critical support. In fact, this is the 50 exponential moving average, which has held it. And we have not broken this 50 exponential moving average anytime during that November to now bull run that we've seen. 3,800 continues to be the point we need to close against. You need a daily close underneath this 50 exponential to trigger further selling. The selling will most likely go towards this 3,700. And then underneath that 3,700, we could even have the 3,600 zone, which is previous resistance in the September and November kind of point highs where it did find some area of congestion. Now, structure here would dictate there is some buying pressure. Let's have a look at the weekly just to get an idea of what's actually going on here. And you'll notice that the 3,700 is also the weekly 20, which has been one of the best pickup zones. So for dip buyers, what do you do? How do you understand this? How do you trade this? Closure under 3,800 technically means a movement to the next area. That could be something that you look at on your charts and come up with your own conclusions. 3,700 could be a zone where you say, well, it's hit the 20 moving average every other time and it's bought off it. I'm interested in that. But there are other considerations right now. How far away are we from the monthly 20? Has the monthly 20 been a good point of pullbacks throughout time? Here's some consolidation through 15 into 16. Here's some consolidation from 18 into the end of 18. So yes, the monthly 20 is a point of consideration when you're thinking about pullbacks. Now that would be a very severe pullback and more, it would actually take the stock market into a bear market instantaneously. But are we too extended? I think the only way to answer that is to look at this chart on the Nasdaq. And I can tell you, I've never seen this chart before on a monthly on any of the major stock market indices in the US. This is a double rejection wick monthly candle, now confirmed and closed. Basically a shooting star followed by a pretty much rejection style shooting star candle at a similar point. It all kind of lines up to something similar that happened last year during the pandemic period. We had a high, we knew about this disease, we knew about everything that was happening, then the market made a new high and then got crushed after that. What happened last month? The market made a high, moved down, then the market moved up again at the same date, pretty much turned, and all of a sudden now we're sitting with a shooting star monthly close. To put it in perspective, we've just never seen it before. Look at these candles. Have you ever seen throughout this? We're back in 1997. We can go back into 1993. We can go back to any point in time. There's really never been these type of candles. There's been long leg kind of rejection wicks and big height around the tech bubble. But even into the GFC, all these recoveries, we've never had this type of negative sentiment on the markets from a candle perspective. What do you do here? Well, you have to say what happened after pullbacks in these pairs. Monthly 20s were quite a common occurrence in the Nasdaq. Monthly 20 puts us down to probably this structure when they meet each other, which would be around 11,000. So it's a pretty significant fall in the market should it occur. And how do we tell that this is going to happen? Well, I think the only way to do it is probably to look at the reoccurring events throughout time. We go back to the monthly here. We scroll down and we think of, okay, where did we close? Here. Where was the last low? Here. So until we really close, let's say March was underneath this, or at least a quality weekly underneath these lows here, I don't think you could say, yes, we're going to move further down to the 11,000-ish area where we meet the 20 exponential. That's the type of thing that you usually do though. When you see shooting stars, you don't just say, oh, I'm going to short the market. You wait for some confirmation, follow through momentum. We're still at critical supports on the S&P 500. We're still at critical supports on the Nasdaq as well. So it's an incredibly important time here for the market for sentiment. But I have never seen this particular setup on so many stocks, because it's on a lot of the tech stocks and the Nasdaq itself. Structure at 12,000 better hold, because if it doesn't hold, you're going back to 11,000. And that's just because the market is euphoric, valuations are high, and possibly they're trying to trap all these new retail traders in expiring options calls and all of those types of things. Am I bearish for the rest of the year? No. I think the bearish sentiment may be sustained possibly through March. Maybe we even bounce here. We've seen that S&P hit that first support. But if we do have a bad March, I would expect April to be a very good month because statistically it holds up throughout time. Now, what are some of the caveats that also could stop this? Things like Papa Powell. We have later on this week, you come through and you think Fed Chair Powell speaks on Friday, March 5th. And at the same time, you've also got the non-farm payrolls Saturday, my time. Now, I'm in Australia, so this is forexfactory.com. You would be best off to check your times on this one. But forexfactory.com calendar, you can set it to your time. Fed Chair Powell speaks, and then we've got the non-farm payrolls figures. If these do not meet market expectations, and we don't know which way they're going to look at things, this could be one of the catalysts that continues to fall the market with concerns with those bonds that, again, I don't think they hit hypergrowth stocks. In fact, 10-year treasuries have generally performed pretty well with the Nasdaq, with industrials, with other things. So don't get caught up necessarily in that narrative. The narrative for me is that we have euphoric positions and nasty Wall Street wanting to take advantage of us, the retail trader. The way they do that, making as much money as possible, which has to do with call expiries, leverage, and also taking some of the froth out of the market. So stay well this week, guys. Come join us, of course, in the live streams. Good luck to everybody. And it's going to be another interesting month, I believe, in the stock markets. Catch you on Monday. Bye for now.